Welcome to another episode of the Old Fashioned Real Estate Show. We're doing this virtually today. I'm Brian Leybovich with our guest hosts. I'll get it one day.
You'll get it eventually. It's reversed, but yeah. So guest host, right? Because it was my idea for the show. That's definitely nice. Thank you. But we do have a guest today. So in a way, I'm a host of guests. So we have a very exciting guest today, the most attractive man in real estate. He told us beforehand to make sure we focused on his looks. He said the best part about him is his looks. So with that, we'll bring on Ben Leybovich, who you probably have heard of. Brian, have you heard of him?
Very excited to have this discussion.
I imagine you are. All right. Well, listen, I will bring him on right after this.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leybovich and Jeffrey Holst for our old fashioned real estate advice.
I gotta be honest, Ben, watching that intro made me think that we shouldn't do this so early in the day because I want to be drinking right now.
So what's the problem?
I don't know. It's still morning where you're at because you're West Coast time, right?
Yeah, but I'm in real estate.
I would reiterate, yeah.
Whatever, dude.
Yeah, it's true.
To be with you guys. This is going to be fun.
Oh yeah, no, super happy to have you here. We argue all the time on Facebook. We have constant disagreements, and you like to poke at me a little bit. So I figured I'd just bring you on and let you do it live.
Yeah, absolutely. And I feel guilty every time we have one of those disagreements because I know I'm right.
Yeah. I mean, it happens. I can't be right every time. I mean, there's got to be at least one person in the world smarter and better looking than me.
You and Jeff will get along perfectly.
You're the audience. Every time I crack a joke, I just look at your reaction. If it's there, it's good. That's how this works. And then
perfect.
Jeff is the butt of every joke, I guess.
Yeah. Well, that's not the worst thing that's ever happened to me.
That's what Jillian says anyhow, but that's a whole another conversation.
I don't know who you're talking about. Who's this Jillian person?
What, you didn't get a call today yet?
Yeah, well, for people who don't know, Jillian that he's referring to as Jillian Sidoti, and we actually, Brian, point up for me, would you? Perfect. We actually will tag the video where we interviewed her right above Brian's head there. So, Jillian is very entertaining. She even sang on our show. So you have big shoes to fill, I guess, Ben. Are you gonna sing for us today, like Jillian did, since you brought her on?
No, but I could play my fiddle. But
again,
we're straying a little
bit off of the real estate. Yeah. So no, but really, we wanted to bring you on to talk about fiddling and singing. But if you want to talk about real estate, we could do that. So. Why don't we start with this? You're a multifamily syndicator. I think most people know that. They may have seen you on the Bigger Pockets podcast, or I think you're on Grant Cardone's podcast. I mean, you've been pretty much everywhere. Of course, nothing as important as being on the Old Fashioned Real Estate Show. But you've been doing the multifamily syndication for how long now?
I've been doing multifamily for a long time. The syndication, 3 or 4 years.
Okay. I think I heard on one of your shows that you were in smaller multifamily on your own first. That's where you started out, which is kind of where I play, right? This is one of the things we disagree with each other on. You always are saying to me, I need to stop buying small deals. So why don't we talk about that first? Why do you think that?
Well, there are many reasons. I just had a call with, I'll break it down with math, okay? Because you guys are smart. I'll break it down with math. Literally this morning, I had a guy called me. He's a guy I've known, I think, from Columbus, Ohio, or Cincinnati, Ohio, from Ohio days, back, going 5, 6 years ago, 7 years ago. He called me and he said, listen, I'm looking at a deal. It's a 90-plus unit, and it's off market. It's through a wholesaler. The average rents are $300, and they need to be $700, okay? So there's obviously fabulous value add in that play, okay? Why would Ben Leybovich never look at a deal like that? Because I'm looking at a fully repositioned deal where rents are $700 And that means something to me. So one thing that means to me is a depressed location, because in this cycle, if your rents are still 700 and you've just ripped out all of the cabinets and put granite tops on the new cabinets, and this is all you can get is 700, then you're talking about a depressed location. What does that mean? That means my exit is going to be capitalized in a fairly high cap rate, which means it's very difficult for me to convert the value from that value add of $400 into actual balance sheet value, okay? This may sound like Chinese to some listeners, and you may spend the next year translating what I said to your listeners, but this is the key. So that's one of the issues. The second issue to me is how do you project future? If in this cycle today in 2021, this is the kind of depressed location we're talking about, then how do you project future? And if you how do you syndicate that if you can't project future? So that's a second thing. And then purely mathematically, purely mechanically, there's a cost associated with operating multifamily. Some of those costs are fixed costs as far as dollar amount. I'll give you an example. If I want to advertise on apartments.com, it's going to cost me $2,000 a month, let's say. Okay. Whether I have a 60-unit building or I have a 200-unit building, it's going to cost me $2,000 per month. Well, that $2,000 per month is going to be spread over 60 units or 200 units. Which one is it easier to absorb in? Okay. A different example is if that same $2,000 has to be spread over rents of $700 versus rents of $1,100, which one is it easier to absorb in? So majority of the costs in multifamily are not percentages, they're dollar amounts. Your payroll is a dollar amount. Your operating, your admin cost is always going to be a dollar amount. Your telephone line doesn't cost you a percentage of how much income you have. It costs you what it costs you because it costs you that much. That's all there's to it. And so that's the case with most of the costs associated with operating a multifamily in any market. So I know, because I know that I need $140,000 a year in payroll to run a multifamily property. So the only question becomes, how much revenue top line do I need in order to be able to absorb that payroll and the numbers still work out? Well, at $700 for 90 plus units, that just don't do it. Okay. That means you are cutting CapEx, you're cutting OpEx elsewhere, or you are doing a square peg in a round hole with the management ecosystem, which means it's non-institutional, which means how do you syndicate for that? If you're going to be honest with your investors, and if they have half a brain, how do you do that? So that's why I want it to be institutional, because the money that I syndicate needs a lot of redundancy, as it should. It should demand redundancy. So therefore, I have to be able to pick up an employee, move them, bring another employee, same with management company, same with every piece of the ecosystem associated with running this multifamily. In order to do that, I need a certain amount of top line revenue, which is a function of number of units in the deal and the type of post-renovated revenue I'm going to have in each one of those units. So this particular deal fails on $700 is just not enough at today's cost. 10 years ago, it would have been enough, but salaries have increased over the last 10 years. Lumber prices have increased. Copper has increased. Repair and maintenance has increased. Everything is increased. HVAC is increased, okay? It's become very, very difficult to absorb those increases into a $700 rent. So I need a higher blended weighted per unit rent in a deal if it's going to be only, let's say, 90 units. Now, the next step after that is, well, what if it's 160 units? Now the revenue per unit is lower. The problem there is that some of the bigger items, such as payroll, you need more of it. Okay. So what I told him is I said, listen, find yourself a 110, 120 unit deal. You can still run it with one in the office and one in the maintenance, if it's a good one. So you're absorbing, now you're getting a whole bump in your revenue, but you're absorbing, the biggest cost into a lot more units. Now you have something to at least consider. Otherwise, you're going to be self-managing, putting your suspenders on and doing that whole spiel. And I don't want any piece of it, which is why Ben Leybovich doesn't look at that deal. And that's why I've left small multifamily. Life's too short, in my opinion, to be in the small.
So the counterpoint to this is, though, I've heard you say many times that you have to look at multifamily like a flip, right? Like, I mean, in order to fully analyze it, you really have to look at what you're paying and then, what your exit's going to be. And if you're buying a 90 unit with a, double, you're going to be able to potentially double the NOI from wherever it is. If you're buying it for the right price, can't that be a good flip if you're not planning on holding it long-term anyway?
Well, who is going to be the buyer? If you talk about $400 value add, and then you capitalize it at something reasonable like a 6 or a 7, you're going to have a $5, $6, $7 million exit. Who's your buyer? Is your buyer going to be willing to wear the suspenders and jump through the same hoops you are willing to jump through in order to manage that thing? Or is your buyer going to need to somehow institutionalize the ecosystem? And that's the problem. Because you can't get into a deal with a clouded exit. And your exit is clouded if you don't know who is going to buy it and why they would. So the kind of buyer, the high net worth doctor, the conglomerate of CPAs, the kind of buyer that's likely to pay you that $6 million for that 90 unit, they're not going to manage it themselves. They're going to do the numbers. And then you may have an issue. So if you're smart and you can figure out mechanically how you would represent that and sell it to them, then okay. I'm just saying it's a square peg, round hole exercise. And you might as well go to the institutional side if you're going to appeal to institutional buyers. And this is one of those deals that doesn't fit the box. And unfortunately, it's not that there's not opportunity there, but it's just a different kind of opportunity. Now, you mentioned I look at everything as a flip. I do, but it's not because I want to flip it. It's because I want to create a lot of value. Looking at something as a flip forces my mindset to focus less on the cash flow and more on what happens on the balance sheet as a result of this deal. Because I want to be rich and I want my investors to be rich. That's the point.
By the way, Ben, this is the most quiet I've ever seen Jeff on a single one of these episodes yet. So congratulations.
I could take that in so many different directions.
I would refer everyone to the Harry Dent episode where I only said 4 words the whole time.
Well, I mean, you're asking the question. I'm telling you the answer. It's not really rocket science. And then everybody thinks they can outsmart the market. They can outperform the market. But listen, if that was the case, how come Yardi has every possible metric on every possible type of property and every possible location and vintage that you can, imagine, or Iron Report, or a dozen other reports? I mean, there's no magic to this. We know how this works. Professionals know how this works. You're not going to outsmart the dynamics of the market consistently for a long period of time. You can get lucky once here, once there, but you're not going to get lucky all the time forever and ever.
That's actually a really interesting point, because I feel like a lot of people, not just syndicators, but a lot of people in multifamily from the 10 unit to the 500 unit space right now think they're smarter than they are because they started investing 5 years ago. I'm not accusing you of that. It's something I worry about for myself all the time, because we've done fairly well the last few years. And I think to myself, okay, remind yourself today that the reason you did this well is because the market has helped you a lot. And,
right.
And I have to keep reminding myself of that. And I think that's an important thing. And I know you're aware of it because I've heard you mention it as much. Maybe even on a recent Facebook post where you talked about exiting on Haven on Peoria, right? That was one you just sold.
Yeah. It's all, you can't get greedy. You can't get greedy. Once you hit your hurdles, if you're going to be approaching investing of any kind professionally, then you have to identify your hurdles. And once you hit them, you can't be greedy, because you don't know what happens tomorrow. And I don't ever want to be the guy that said to my investors, we can do better, whereas I could double their money right now. But I didn't pull it because I thought I could triple it. And then the market cycles in a different direction. And then I am the guy that is not so smart looking all of a sudden. So I'm a firm believer in what I call risk-adjusted returns. There has to be an inflection point where enough is enough. You can't get greedy. You get caught when you get greedy. And I don't want to be in that position. Right now, I have latitude to do either or. So it's a great position to be in. So you can't lose money by taking profits.
What led you to, when did you sort of come to that realization that you've just been discussing? Because you started in Ohio. I've been reading you on Bigger Pockets for years and years and years. And I've been off a little bit more recently. I know you're obviously working out of Phoenix metro area. So how did you decide to make that jump?
Well, that was 2013. And I think it was part of personal growth more so than anything else. I mean, like one day you wake up, look at yourself in the mirror and realize if I have to buy another fucking fourplex again, I'm going to shoot myself. Quite literally,
I promise not to buy any fourplexes today. I might buy one tomorrow. I'm actually closing one tomorrow, but that's a different issue.
I don't mind. No, but see, that was it. I didn't know who I was yet, but I knew I wasn't the person that I'd been before. It's like I've learned everything there is to learn about a fourplex, and a sixplex, and a 10plex, and there's no growth in that. Like I'll give you this example. I am all about exponentiality. I don't like linear anything. It drives me crazy. Like I feel like I'm doing something wrong when this is happening. I like this because this is a function of knowledge base. So I feel alive. I feel like I'm learning something when I'm able to go like from here to there. But I was here. And I could have continued to slowly build up and build up. I could have done that. My family would have been okay. I'd have had some cash flow, all of this. But I'd have been bored to death. And that's not what life is about. So I realized I had to go institutional, had to go bigger. But I didn't want to do it in the Midwest. I didn't trust the Midwest. It's not a growth market anywhere in the Midwest. And, Columbus being kind of the best of the best. But even that's, like comparing a dick to a finger. When you compare Columbus to Phoenix, your audience is going to love that.
You may actually, so the first person ever to cuss on our show was actually Matt Faircloth. So you're in good company.
He's traveling me probably. He's like, dude, if Ben can do it, I can do it.
Yeah, that's exactly right. And then after that, Brian was like, well, fuck it. If Matt can cuss, I'm going to do it. So, now we have an open door cussing policy here, Ben. So you're completely fine.
That's funny. Well, but that's why I knew I wanted to go. I needed for personal growth reasons to be a happy man. I needed to go bigger, but to go bigger, I needed to bring on capital, but I couldn't wrap my head around doing it in Ohio. So I started looking at, a few markets in Phoenix. I just loved Phoenix, and it made sense for my wife, my kids, everything, the palm trees, the blue skies, everything. So that's why Phoenix.
Yeah, no, I mean, it makes sense to me. I'm a big fan of doing what feels right to you, right? Like I believe that a lot. Maybe not in investing because, it's important to also run the numbers, but for deciding where to live, yeah, that's exactly what you do. You pick a market that works for you and then go find a place. And Brian's done that too. I mean, Brian's from Southern California. He chose to come here, right, Brian? Like Chattanooga?
Yeah. Sort of the opposite, but yeah, I mean, different reasons. California's high cost of living, high tax, etc. And I just like the opportunities that were present here, obviously, versus in California. So, but not as many. Not as many 200 and 300 unit properties here, certainly, as there are in my home state. So.
Yeah, I know. That's the one thing about our market is that, like, the idea of buying if we want to expand geographically, sure, right? Because there's no rule that says we have to buy in Chattanooga. But if we're going to buy in Chattanooga, there's not a lot of options for 200, 250 unit buildings. It's just the population doesn't support that size of complex. Which, of course, you would say is a good reason not to buy in Chattanooga, I'm sure. But Chattanooga has growth and rent growth and price appreciation and all these other, employment growth metrics that make it attractive.
Whether it's Jesus or Moses, I don't care which one of you helps those guys, but please help them.
Yeah, if just give us a little more growth and we'll be fine, right?
I don't know anything about your market.
No, I know. I'm teasing you, but
it's certainly not a market that appears in any growth charts I look at. But it's
a small market, right? I mean, it's super tertiary market, so it's not going to show up on the institutional grade stuff. I've said for a long time, the reason that I do what I do is that I like that sweet spot above the mom and pop operators, below the institutional people, because there's less competition and we can get extraordinary returns as a result of that. That won't be true, like you said, if you can't exit, right? Because the returns come at exit for the most part. I mean, the cash flow is nice, but if you can't refinance or sell, then you're not going to get that return from the balance sheet side, which is the important side. But so far, we haven't had that issue. So there's that.
Good. I just... time value of money, time value of time, or money value of time, all of that. It's like you're going to put a deal together, might as well be 30 million.
Yeah, I mean, except for when's the last time you bought a $30 million deal and found a mannequin in the basement? I mean, I had that happen to me this year. I mean, you can't really compete with that.
No. If that's the objective, Jeff, I cannot compete with that. No, but clearly we approach this business differently, right? You are a quintessential investor. You purchased a property to use it as an investment vehicle. I am a syndicator. I'm a sponsor. So I still have some portfolio that I own on my own, but what I do is more akin to financial engineering. It's more akin to money management, with real estate, being used as a vehicle to underpin it. But it's a completely different approach. And as a money manager, I have to, I have to go to a market that a lot of people have a reason to be in. Because that's where the safety is. I have to take the approach of don't lose money first, then worry about making money. Well, how do you not lose money? You go to a growth market, and Phoenix is number one on that list. And so it's not that you can't make money the way you do, the way anybody else does in any other market. It's just that I have a higher standard that I have to hold myself to, because I'm playing with a lot of people's money. And so I got to be in a growth market. The bigger, the better.
So the last deal you did in Ohio, what size was that? And then
it was a 10 unit.
Your first deal you did in Phoenix?
It was a 10 unit. I did a 10 unit in Ohio in 2013. I stabilized it. I still own it. Does just fine. But then I went and bought 100 units in Phoenix.
Okay.
So I went from $400,000 to $8 million.
It's a pretty big jump, 20 times.
It's exponential. And the offers we're putting in now, you're talking, depending on the class of product, but you're talking $200,000 and $340,000 a door.
It's a big chunk. I mean, there's no doubt.
Yep.
But I mean, if the returns support it, it doesn't. I mean, at some level, this is all just a math game, right? I mean, if it works, it works.
It's a math game, but you got to realize there's a reason why institutional money isn't interested in going where you are, which is why you are where you are, because you're trying to avoid institutional money, right? It's not going there because it understands that it's inefficient at running multifamily. So it needs to find safety by other means other than operations, other than being efficient, because they understand that they're so far removed from it, they can't impact in a meaningful way operations. So they will overpay for the property based on as a function of income to purchase price. So they will pay a 3.5 or a 4 cap for a property that is in high growth market that throughout the pandemic rents grew 7.5%. And the population growth is staggering. So that's where they go because they know they're not entrepreneurial. They just need some place to stash money that they don't lose. And that's what drives the pricing in a market like Phoenix, because it's all institutional money coming in. So it's not going where you are, even though the cap rates are higher.
Well, and I get that. I mean, without getting too esoteric, though, aren't you worried about the interest rate risk associated with low cap rate product? Because if you have interest rates go up 1%, let's say, and you're in a 3 cap market, you could lose a third of your value. Where in a 10 cap market, it might be 10% of your value because interest rates tend to drive cap rates in tandem.
Yeah, but they haven't so far.
Well, they haven't gone up so far, but there's still the risk that they might.
Did. 3 years ago, interest rates gone up quite a bit, and the cap rates compressed at the same time. So first of all, your argument doesn't really stand up to recent past, and then you have to ask a question, why not? Because typically that would be the thing you believe. And then you go and you log on to see what the LIBOR curve is at Chatham Financial or somebody whose business is to study this stuff. And you realize that the professionals who are pricing insurance products based on the movement of the interest rate, don't see it going up for the next 3 years. And then, when it does go up, it's almost meaningless. But that's beside, I don't guess about these things. Again, because I'm institutional and I don't have enough knowledge to offer an opinion. So I go to the professionals who study this, who have a right to offer an opinion. I don't have a right to have an opinion. I'm not an economist. It would be bullshit opinion. Nobody should listen to my opinion. So I go to the people that study this business and study the Fed and understand how to project this stuff in the future. That would be one way to answer the question. Second way to answer the question is, typically in the past it has, but it hasn't in the recent past. So do the interest rates move in tandem with the cap rates? I don't know. I'm not educated enough. As educated as I am, I'm not educated to make that call. Okay. Lastly, I didn't say I buy at a 3.5 cap.
Fair enough.
I will buy at a 3 cap, and then I will do my value add, and I'll be at 5.5 to 6 cap on my basis. So if the interest rates move up 1%, I can sustain it. Okay?
Yeah, that's a solid point, actually, and that's how I think about it too. To me, it's always like, well, I'm more concerned about what's my stabilized cap rate than what I'm buying at, because it does create safety.
It's all about, because you guys threw out this phrase. It's all about, at the end of the day, it's all about the numbers. Yeah, but what numbers? Which numbers? If you try to go and capitalize an NOI and place NOI on any property in Phoenix, you can't buy shit. That's just not how that works. It hasn't worked this way in 4 or 5 years that I've been here. So that's not what this game is about. So yeah, maybe it's about the numbers, but it's not about the numbers that most people think it's about. But the interest rate risk, you should be pricing it in. I mean, and you should be basing what you price in based on opinions of people like Chatham Financial, who are going to sell you an insurance cap product on that floating rate Freddie Mac 10-year loan that's going to cost you a premium to pay, and they will lose money if they don't charge you enough premium, and they figure out the premium based on what their research says the interest rates are going to do. I can tell you they don't think it's going to do much based on the premiums we've been paying, right? So that's neither here nor there. I'm not offering an opinion here. I'm just telling you, it doesn't really pay to have an opinion. There's information out there, professional information out there, so go get it.
And you can also hedge the risk by buying insurance products, right? So if it does happen, you recapture the gain somewhere else.
Well, not only can you, but you should. I mean, the lender won't let you. I mean, like institutionally, like Freddie Mac, Fannie Mae, or any kind of bridge lender, any kind of debt fund that we would do business with, they have a requirement. It's going to be a floating interest rate product, but they have a requirement that we purchase a cap to put a ceiling on that interest rate. Now, they don't require nearly as much cap as what we buy. We buy a lot more of that insurance to lower that ceiling so that we know what we're dealing with in the next 3, 4, 5 years. But it's, you're entering more institutional thinking about this, right? Like I would never, ever get a fixed rate loan on one of these big assets that we buy, ever. It's just the stupidest idea.
That's a different way to look at it, and I think you're right on a big asset because your fixed rate absorbs. It might cap your upside risk, but it also caps the advantage of falling rates.
Not even that. The fixed rate products always have prepayment.
Oh yeah, huge prepayments, right? And that's
prepayment penalties with defeasance and yield maintenance and things like that on a $20 million loan. I'm exiting a deal right now. I'm not going to say that because that's not public yet. Haven on Peoria. So that's public. So we sold that and we purchased it for 20, sold it for 28. Imagine if you had a $3 million yield maintenance.
I've been there.
We got out of it in 21 months. If you lock in a 10-year or even a 7-year, you could be looking at $3 to $4 million easily on that size of a loan with Fannie and Freddie. Well, that destroys my returns. And guess what? Now I can't exit. Well, now my investors are looking at me. Whoa, wait a second. You can give me a 25% IRR right now by selling it, but you're not gonna because you're stupid enough to get yourself into a loan product with prepayment penalty that's going to destroy these returns. And that's what the amateur hour's done.
Yeah, no, I mean, I see that a lot. In fact, I mean, I don't like to admit it, but I did that on my very first non-recourse product. And we still have it, and we have tons of equity tied up because we don't want to refinance it because it's got a big, it's not $3 million, but it's, $400,000 prepayment penalty, 9.5 years of yield maintenance. Didn't even know what it was when I signed it. That was a mistake. Fortunately, I've learned a little bit since then. That was, a few years back. So, so I'm not doing that again, but that is a very good point. And that's something that I tell people all the time when they start looking into, institutional grade financing is you better be looking at those prepayment penalties, and the loan terms matter a lot.
A lot.
A lot more than they do on like regional or community bank stuff, because there's usually something very intuitive to how.
If you have a step down 5.5, 4.5, I mean,
you can just know what it is, and you can model it in and say, I'm going to keep it for 5 years or 3 to 5 years, and if I get rid of it at 3 years, it needs to be this price, or it doesn't make sense.
That's right. And because I'm a sponsor and I manage people's money, essentially, I want to be able to pivot. So I get loan products that give me a 12-month, maybe lockout period that I can't do anything for 12 months. But after that point, I can pivot any way I want. I can refinance, and I've done that. I can sell, and I've done that. I can go into permanent financing, and I've done that. I can't imagine having one of these big deals and being handcuffed and not being able to execute a pivot based on the market. Canyon 35, when COVID hit, like 2 weeks before COVID, we put it on the market. We would have sold it. But then COVID hit, the market went to shitter. And so we went to Freddie and we refinanced it and pulled out a bunch of money. That created a bunch of additional cash flow. We finished the renovations and we'll exit soon enough. But I mean, having the flexibility to execute a pivot is by far the most valuable thing you can give yourself.
And I think that's true even for non-institutional product, by the way. I think that you need to have that flexibility. That's something that Brian and I talk about a lot. And we've done a few of the deals that you don't like us doing together. Most of the time when I post a deal somewhere, like in the Facebook group or something, that's something I did with Brian. So you can pick on him too. He's the secret, quiet, sitting behind the scenes, not telling anyone he's doing it guy.
Well, you're the guy that likes to be all over social media. So,
I don't like to. I just do it because it's a business thing. Like I have to. I don't have a choice. All right, Brian, do you have any more questions? I don't want to keep Ben too long here. We appreciate you coming. So what do you got, Brian? Anything you've been burning in your brain, waiting to ask Ben?
I think it's been instructive for our massive audience, as well as I would say both of us, right? So super. I'm going to go back and review it later. So if people want to find you, Ben, the best place to find you is whitehavencapital.com.
Yeah, that's one place. Yep.
Is there anywhere else you'd like to share? Because we're happy to share whatever links and stuff. Because some people will listen to this in podcast form. They won't actually see the screen. So
the easiest thing to do is www.whitehavencapital.com. And there's a contact form on the website, and you can reach out through that form. You can reach out to me on Bigger Pockets. You can reach out to me on Facebook, a couple different places. But I've done a lot of things over time, but for the past 4 years or so, it's Whitehaven Capital, and then for the foreseeable future, that's probably where you're going to find me.
All right, fair enough. Well, all right, so I have one last question, and that is, you said you like exponential growth, right? Yes. And that's why you got into what you're doing now. So what's next then? Like how do you keep growing exponentially when you're already doing what most people would consider giant deals?
So that's a good question, because Sam and I, my partner Sam Grooms, and I just talked about it this morning. I don't know, and it's pissing me off.
Fair enough.
I'm really struggling right now. Like we've been so extraordinarily successful identifying a business model that put us right in front of the curve. And now the curve has caught up to us, and we're exiting, and we're making people so much money. I don't know what's next, and it's eating at me a little bit. Frankly, I don't know. On the one hand, I've made enough money, I can retire. On the other hand, I'd be bored as shit, and my wife would kill me.
Oh, it would be terrible.
I would get no sex. Do you understand, guys? Zero. Like, it would be bad. It would be the worst thing. I have to be productive, because I turn into like a more difficult person than I am right now. Like, I turn into a really difficult person.
For what it's worth, I don't actually find you difficult. Whenever you poke at my deals on Bigger Pockets or wherever, I'm always happy, because I'm like, see, Ben's paying attention to me. It makes me feel proud. I mean, when the most attractive man in real estate is noticing you, then you kind of feel like the cool girl at the party.
You got to do me a favor, and you got to call Brian Burke, and you got to tell him that you're in my corner, and I am the most attractive man.
I will do that. I will definitely. I mean, in fact, I'll give you a little clip, and you can just share it with him as many times as you want. Every time he argues, you can just be like, here's the clip. It proves it.
He doesn't tend to argue with me anymore. I learned well. He taught me a lot.
A smart guy, actually. Yeah. Anyway, so what's that, Brian?
No, nothing. I was just laughing. Would you ever consider yourself, though, just one follow-up, taking your model now, staying in Phoenix, though, but just expanding it to other markets?
We haven't done it thus far. Frankly, economically speaking, the way Arizona works is Phoenix is the engine. Mm-hmm. Look at it this way. If you pick up Phoenix and take it away, nothing else matters.
Yeah.
Tucson doesn't matter. Nothing else matters. Phoenix is where the cycle starts. And then when it gets too expensive, people go south and they go north and they try to go to Tucson and they try to do that. And, my perspective is if you are going to be going after quality, then there's no place other than Phoenix that you should be focusing on in Arizona. Not to say that you can't make money, but it becomes more transactional and it becomes more momentum. Because Phoenix is where it starts, and then the coattails, and then all these markets ride the coattails. But eventually, when there's a downturn, Phoenix does this, and it takes much, much longer for everything else to recover. And because we're late in the cycle, as bullish as I am, I would much rather stay in Phoenix because it's going to recover faster. Listen, in the past month, we've had announcements from TSM, Intel, and what do you call them? Another semiconductor. Basically, Phoenix is becoming the capital of semiconductor, as far as I can tell. And part of it is political pressure, clearly coming out of the shortages and, all of that. Part of it is they see the writing on the wall in Taiwan with China and all of that. So it's not surprising. Okay. But I guess you could say, well, if Phoenix is going to be this strong, everything else is going to be this strong. So why don't you go spend less and buy something in Tucson? I suppose you could say that. I'm so conservative in nature. I would still just rather be here, the heart of everything that happens in Arizona. Even if I have to pay more.
What about non-Arizona, though? Why not pick a similar economic driver in a different state or a different region?
So that's a different question. That's a question of lifestyle. I don't want to be on a plane. I don't want to be in the car. I'm not going to set up a construction company like we've set up Whitehaven Construction, which is a lot of the reasons we can do things the way that we do things is we own our construction company. We have people on payroll. We pay them health insurance. We control the process to an infinitely greater degree than most people can. I'm not going to replicate that in another market. A, because I can't do it from here. B, because I frankly don't want to do it. I know what it took. I don't want to do it again. Maybe it's a business model that makes us a lot of money quickly, and then we outlast the model and the cycle has changed and we can no longer operate in that model. Well, we'll pivot if we can, or we stop if we can't. But the idea of going to another market is not appealing to either me or Sam. And I can't take $10 million of your money and put it in a market where I don't have certain competitive advantages. In that way, I'm not what you would call a syndicator. I see it as an opportunistic business venture that works until it doesn't. Yes, it can work in every different market, but you have to be willing to go to every different market to chase that cycle or stay ahead of that cycle. I'm not willing to do that.
That's actually the best answer of the day. So we should definitely leave you there because I agree 100%. There's the lifestyle part is more important than chasing a couple extra bucks somewhere else. So that's great. Ben, thank you so much for being here.
Appreciate your time. This has been great.
Yeah. And if you ever want to come on again, you just let us know like you did this time and elbow your way back onto the show. Because I know this is probably the highlight of your life being on the Old Fashioned Real Estate Show. I mean,
Of course.
Thursday morning. Yeah.
At least the highlight of Thursday morning. So thank you so much. And once the show is out, I'll be sure to share it with you. Thank you again.
Thank you. And I'll make sure and share it with my audience. And I appreciate the invite, and this was fun. Hopefully, it was entertaining.
Very, very much.
Reach out.
Thank you again. Thanks.
Thanks, gentlemen.